Investing is fun and enjoyable until you make the biggest mistake that everyone does and start losing money. Nobody wants to lose money, but the vast majority here will make a mistake. Let me tell you 5 types of advice that will definitely save you money. Of course, I'm not a financial advisor, so seek a financial advisor for expert advice. First advice, don't invest in individual stocks if you don't understand them. Individual stocks are riskier than bonds or some ETFs. If you're just starting to learn about financial literacy and don't know how to evaluate individual stocks or what basis to make decisions on, then you're not ready to invest in individual stocks. If you're young, have time, and the desire to learn how to invest in individual stocks, then initially invest your money in ETFs and start learning. Subscribe to this channel as it teaches how to select individual stocks and financial literacy. The most well-known ETF replicates the S&P 500 index, but you don't have to invest in it. You can choose from a wide range of other ETFs. By investing in ETFs, you'll have more motivation to take an interest, and if you see any earnings, it will draw you in even more. After investing in ETFs, start learning. I would start with general knowledge first, and then focus on valuing stocks, for example, using the DCF model. Once you're confident in valuation, you can move a portion of your money from ETFs to stocks. And when you're absolutely sure, you can take all your money and invest it in individual stocks. Second advice, invest what you can afford to lose. When you start investing, you'll need some capital. Everyone says you need a ton of money for investing. That's not true, at least not at the beginning until you learn it. Initially, you need to learn to invest, and even a small capital can serve that purpose. You'll need a large capital only after you've learned to invest and gained confidence. For starters, very little is actually needed, the main rule being not to invest what you can't afford to lose. One of the main mistakes is when an inexperienced investor takes all their money, starts losing it, and keeps losing until only 75% of their capital remains. This is a terrible mistake. Take the money that would otherwise just sit in the bank and start with that. Don't touch the money needed for essential things, or the money you'll need in the near future, say within 5 years, because if you use and start losing it, it will instill fear of loss in you, and you'll withdraw the money at a loss. Third advice, diversify. Diversification is investing money in multiple companies to reduce the risk of loss. You've reached a stage where you've learned to value stocks and are starting to invest. A single stock represents some risk of bankruptcy or loss. But what if you have 10 stocks in your portfolio? That's a relatively small chance that all 10 companies will go bankrupt, reducing the risk of loss. The main reason for diversifying is to reduce the risk of loss. If you're just starting, you probably don't have the best and most reliable valuation, and diversification can compensate for that. 2 questions arise. How long and how much should we diversify? The duration of diversification depends solely on you, your abilities, certainty, attitude toward loss, and motivation for investing. All these questions play a role in how long you should diversify, but the ideal time will be when you have positive results and can substantiate these results with your company analyses. How much should we diversify? It depends on your present and future time, which you have and want to dedicate to it because you must devote some time to each company even after analysis and purchase. You should go through quarterly results, monitor management steps, compare it with the competition, and such simple checks. It's similar to a car. When you buy a car, it doesn't just run, you have to go for checks, and if something breaks, you have to consider replacing the part or selling the entire car. And the same goes for investing. If you buy 100 stocks and have little time, you won't be able to perform such regular checks, which will lead to worse performance of your portfolio. I would say that for starters, the ideal number would be between 5 and 15 stocks. Of course, it could be more, but you must know that you have the time for it. But if you work or study, I think this is the ideal number of stocks. Fourth advice, safety cushion. The safety cushion is how much you buy below the intrinsic value. If you're an inexperienced investor, it's good to minimize the risks of inaccurate analysis. It reduces the risk of loss for inexperienced investors and drastically improves profits for experienced investors. Let's explain this with an example. You calculate that the value of a stock is $100, you decide to use a safety cushion of 25%, and wait until the stock price drops to $75 before buying. That's when your profits increase because, at some point, the stock price aligns with the company's intrinsic value. If you're right, the safety cushion increases your profits, and in our case, it would be 33%. And if you're wrong, it gives you a decent chance to not lose as much as you would have. Now the question arises, how large should the safety cushion be? Again, it depends on your abilities, but generally, the bigger the cushion, the better. If you're very confident and it's more of a dividend company, I'd ask for a minimum cushion of 15%, but that's very little, and I'd rather ask for 25% and more. Of course, it depends on the type of stock and how you've built your portfolio, but leave room for possible mistakes, inaccuracies, or economic upheavals. Fifth advice: if you believe in the companies, don't sell. It may happen that your stocks drop by 10, 20, or even 50% after purchase. Everyone experiences this sometimes, that their stocks are not doing well. But that doesn't mean that the company is bad and you should sell. If your stocks drop by a significant percentage, you must first find out why the stocks fell. Whether it's quarterly results, economic changes, or something negative against the company, you seek such information. Once you find the reason, you must ask yourself, can this reason affect long-term performance? If the answer is yes, then to what extent? And if you're okay with it, continue holding the stocks or not. If this reason doesn't affect long-term performance, then it's some short-term negative news that gives you an opportunity to buy at a discount and increase profits. So, if you're still confident after the drop, and with your prediction, don't sell but buy at a discount because wealth is created there.